application of marginal costing. A manager has to make decisions every now and then. Some of the factors affecting the decision may not be expressed in monetary value. Hence, the manager will have to make qualitative judgments. For example, in deciding which of two personnel should be promoted to a managerial position. A quantitative decision, on the other hand, is possible when the various factors and relationships between them are measurable. This lesson discusses the application of marginal costing. It follows from the previous slide that after studying this lesson, you should be able to understand the application of marginal costing, explain the relevant cost and strategic cost, describe the different ways to increase profit. The firms which are routinely in need of spares, accessories are bought from the outsiders instead of any production or manufacturing, though the requirements is at regular intervals. Most of the automobile manufacturers are usually buying the components from outside instead of producing them on their own. The Maruti Udyog Limited had given a contract to the Nettur Technical Training Foundation, Bangalore, to design the tool for the panel and to manufacture regularly to the tune of the orders. The leading four-wheeler manufacturer in India is buying the panel from the NTTF on contract basis instead of manufacturing. Why don't they manufacture in spite of buying them from the NTTF? The main reason of buying is cheaper than the production of an article. Limiting factors or deterring factors in the decision-making process of making or buying decisions are sales volume, production, labor, materials, and so on. The limiting factor normally differs from one to another. The acceptance of an order is mainly based on the two important covenants, viz., additional cost and additional revenue. If the additional demand of the foreign buyer is able to generate the additional revenue more than the additional cost of the operations, the firm should have to accept the foreign order. In the market, dealership is offered by various companies to the individual intermediaries in promoting the sale of products. Before reaching an agreement with the company to act as a dealer, normally every individual considers the profitability of the product mix offered by the firm. For example, there are two different companies brought forth their advertisements in offering the dealership to the individual trading firms, viz., HCL and IBM. The profitability under the dealership banner should be appropriately considered prior to taking a decision. To take rational decision, the firm should compare the profitability of both different dealership of two different giant industrial brands. The greater the share of profitability in volume will be selected and vice versa. Very often, it becomes necessary for a firm to temporarily close down the factory due to trade recession with a view to reopening it in the future. In such case, the decision should be based on marginal cost analysis. If the products are making a contribution towards fixed expenses, or in other words, if selling price is above the marginal cost, it is preferable to continue because the losses are minimized. Shutdown point can be calculated by the formula given on the screen. Shutdown involves the following types of decisions: whether to close down a factory, department, product line or other activity or not, either because it is making losses or because it is too expensive to run. If we are going to shut down, whether the closure should be permanent or temporary. Shutdown decisions often involve long-term considerations, capital expenditures and revenues. A shutdown should result in savings in annual operating costs in future. Relevant costs are costs that change with respect to a particular decision. Future costs may or may not be relevant. If the future costs are going to be incurred, regardless of the decision that is made, those costs are not relevant. Committed costs are future costs that are not relevant. Even if the future costs are not committed, if we anticipate incurring those costs, regardless of the decision that we make, those costs are not relevant. The only costs that are relevant are those that differ as between the alternatives being considered. To affect a decision, a cost must be related with the future, as we cannot affect the past costs but current decisions, and they are common to all alternatives that we may choose. It should have a meaning, since the expenditure which will be incurred or avoided as a result of making a decision. Expenses such as depreciation are not cash flows and are therefore not relevant. Slide 7. Strategic cost management can be defined as scrutinizing every process within your organization, knocking down departmental barriers, understanding your supplier's business, and helping improve their processes. There are 3 different areas where strategic cost management is applied: strategy, operation, and organization. A strategy refers to a plan of action that will shape the direction of organization's success. Now, companies realize the importance of strategy and its effective implementation. Before making any strategy, the management should think about the business model, whether it is still relevant or needs to be changed. By setting the priorities according to its significance, we can operate the tasks effectively and efficiently. Company should time and again check whether it is allocating its limited resources in the businesses which generate more value for the entire organization. Important steps of strategic cost management include focus, planning and training, fact-finding, analysis and recommendations for changes, and implementation. Now let us check if we have understood the various concepts discussed in this lesson clearly. Committed costs are costs that will occur in the future and that cannot be avoided. Right or wrong? Right. Differential costs are different with relevant costs. Right or wrong? Wrong. A relevant cost for a particular decision is one that remains same if an alternative course of action is taken. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied till so far. A manager has to take different decisions whether to make or buy a product, or if company is making losses in any product or department, then company should continue or shut down that product or department. Relevant cost is very important while making any strategy or decision. Strategy cost management is to use the resources effectively and reduce the total cost of the company.